Hello, I'm Angeline and welcome to Beat the Street, the show that gives you all the tradable news and data you need ahead of the Wall Street Open. Coming up, US stocks, the Christmas rally still in play. But will it last? We'll ask Chris Vecchio from New York, Tasty Live, in just a moment. And PCE and the GDP growth rate, investors now bracing for the last two key data points before markets break for the holiday season. And FedEx shares heading south on its annual revenue forecast cut, and what is shaping up to be a weak holiday season if early details are to be believed. Now, good afternoon. I'm Angeline Ong, and welcome to this new edition of IG's Beat the Street. Not long now before Wall Street starts trading. Before we cross to Chris in New York, here's a look at Wall Street, which mirrors the Dow Jones Industrials. It's called Wall Street on the IG platform, which you can go long or go short on. However, if I widen this out for you, can see that rally that has been in play for some time now, especially after that Fed pivot. Now, all three main indices showing you the US Tech 100 as well. Well, they've all advanced more than 2% since the Fed's December 13th verdict, where policymakers projected lower policy rates by the end of 2024. Just checking in on the US 500 as well. As you can see there, a similar trend. The Dow, though, hitting record highs every other day, pretty much since then. So it has been a big sort of pre-Santa rally here. Let's cross over now to Chris Vecchio, standing by for us in New York. He's from Tasty Live, part of IG Group. Chris, just looking at these advances, have markets got ahead of themselves?
In a certain respect, they have. The markets are currently pricing in effectively 6 rate cuts from the Federal Reserve next year, which, if you look at the calendar, that doesn't make a whole lot of sense. The Fed's not going to raise rates in January, which leaves 7 meetings possible over the rest of the year for them to actually deliver those 6 rate cuts. And 2 of those meetings come within the 2 months before the presidential election, a period of time when the Fed really does not like to change policy at all unless the economy is in the tank. And so 6 rate cuts for 5 meetings, that doesn't really make a lot of sense. If we're going to get that many rate cuts, it probably means we're going to get more than that. So on one hand, it looks like the market is underpricing the risk of what the Fed could do. And on the other hand, it seems like that's way too much in the very short term. That said, this is clearly an environment that's drawing in people off the sidelines. Over the past week, we've seen an incredible amount of money come in to stocks here in the United States. In fact, the SPY ETF, the S&P 500 tracking ETF, has seen net inflows to the tune of $35 billion. To put that in perspective, SPY has only brought in $49 billion the entirety of this calendar year so far. And most of that money is coming in this week. So retail money is coming in off the sidelines. It's helped propping up the market in the short term. We, of course, are heading into the Santa Claus rally period, the final 5 days of the year, the first 2 of the new one, which since 1950, the S&P 500 has averaged a gain of 1.4% nearly 80% of the time. And so this rally can continue here through the end of the year, although once we go into 2024, it may be time for a much needed breather.
Chris, we've also got the PCE and we've also got the GDP growth rate. This is the final reading. Any surprises there?
I don't think so. And it being the final reading for GDP means its ability to impact markets is substantially lower. But what has been happening is that growth expectations for the fourth quarter have been rising actually quite rapidly here over the past week. It was a week ago that the Atlanta Fed GDP Now growth tracker, which for what it's worth has been the most accurate regional Fed branch GDP tracker among all the regional Fed branches over the past year, was looking at a 1.2% growth rate for the fourth quarter. As of yesterday, following the building permits and housing starts data, the fourth quarter GDP tracker was upgraded to 2.7%. So a slowdown in the US, yeah, of course, yes, that's true. From 5.4 to 2.7 would be a slowdown, but it's not a dramatic slowdown. A 2.7% growth rate for the US is still very, very healthy. It keeps a soft landing squarely in mind. I don't think the Federal Reserve is going to be looking at the revision to the third quarter report or even this PCE data too closely as we go into the holidays. People are very content with where the economy stands here and now.
Thanks very much, Chris, and hopefully they stay content as we count down to the end of the year. Have a good Christmas if we don't see you before then. I'm sure we'll have Chris very soon in the start of 2024. Let's check in on the NASDAQ now in particular, because technicals here are showing quite strong signals, and we are currently at the 16,768 level. No thanks to the euphoria that the Fed pivot has caused. For a closer look, IG's Axel Rudolph has been looking at the NASDAQ for us.
NASDAQ 100 is on track for its 8th consecutive week of gains, which is quite incredible. And it is currently flirting with its November 2021 high, as you can see here on the weekly chart. And we briefly traded in all-time record highs earlier this week, but are currently trading around those highs seen back in November 2021. So if I zoom back out again and go into the daily chart, you can see here that we have a very clearly defined uptrend in place, and that looks quite healthy. So there isn't really much downside to be seen here. Now, the only worry I might potentially have is that we're getting into a period now, the festive season, where liquidity will dry up and where you could have higher volatility moves and stops being triggered, etc. At a time when the volatility index, the VIX, is at extreme lows, and also at a time where the CNN greed and fear index is now trading in extreme greed territory, all of which is showing us complacency and could lead over the festive period or perhaps at the beginning of next year to some volatility and perhaps these strong uptrends coming to an end, at least short term. So where's the support for the NASDAQ 100? Well, we've got last Wednesday's high and Thursday's high, so around 16,667. That's minor support. Right now, it seems to be coming off in the pre-opening trading that's taken place at the time for the time being. But basically, you can see here that we've had a series of higher highs and higher lows for the last few days since the 7th of September. And from a medium-term perspective, provided we stay above the current December low around 15,692, the medium-term uptrend is very much intact, and we may well continue to trade in new all-time record highs over the coming days and weeks, and perhaps at the beginning of next year reach the psychological 17,000 mark.
Thanks very much, Axel. Interesting stuff. Now, one of the key sectors that we are looking out for during this holiday season is, of course, anything to do with logistics, anything to do with retail, and actually FedEx ticks those two boxes. FedEx shares indicated lower after reporting earnings and revenue below market estimates, and the company also cut its revenue forecasts. While adjusted earnings rose 23%, it was 20 cents lower than consensus, and the revenue came in at $22.2 billion, $600 million lower than the same quarter a year ago, and this missed estimates of $22.4 billion. FedEx now expecting low single-digit percentage decline in revenues from last year compared with its prior forecast of roughly flat results. Now, FedEx, not an all-session stock on the IG platform, but you can trade it when the cash sessions opens, which is not long now, indicated elsewhere lower. This is FedEx. Now, among the tech-heavy NASDAQ constituents that we are keeping an eye on for you, I'm looking at Meta, just showing this for you because it is all sessions. Meta moving there down 1%. This is, of course, the owner of Facebook. Also checking in on Amazon, as we touched on retail as well, because Amazon is the key one to look out for any signs as to whether or not we're going to have a strong end of year shopping season. Here we are, Amazon all sessions. It is currently down 0.2%. Nvidia also slipping, and so is Apple. And just wanting to check on one more stock for you. This is Alphabet, all sessions as well. Now, Alphabet is one of the gaming stocks, up 1.3% on the IG platform. This is after a report that said Google is looking to reorganize a big part of its 30,000 person ad sales unit. This is according to a person close to the matter. Now, if you remember, in January, Alphabet announced plans to cut 12,000 jobs globally. This was around 6% of its global workforce. And earlier in June, Google also laid off employees at mapping app Waze. This is as it brought together the app's advertising system with Google Ads technology. So keeping an eye on Alphabet there for you. And gold prices in the commodity space is extremely interesting for our clients. Just showing you gold here, if I may. Now, gold has been achieving greater highs, as you can see here. That spike there partly due to the Fed pivot, which then weighed on the dollar. But it is extremely close, getting close again to that 2,100 level. And for many, if it stays above that 2,100 level, it's seen as a key technical indicator that gold can go higher. Earlier, I caught up with Eric Strand, founder and portfolio manager at AUAG Funds, and asked him if gold traders were getting a bit too overexcited or there was more room for gold to head higher.
Well, really nice to be here. And the first answer is no. I mean, the participation is really low from the traders. So there's a lot of room to go now. And what is important is that we have established the gold over 2,000 for a longer time. It has been going up and down around 2,000, but now we get the feeling that we are over. And I think the target is 2,100, and that's when it really starts to fly. So now it's a good time, I think, to position yourself. And we also see good inflows in our ETF for the gold miners. So it's just the beginning, I would say.
And that was Eric Strand, founder and portfolio manager at AUAG Funds. Now, before we go, a quick look at how the market is looking. And as I said earlier, we are seeing that markets are taking a breather now, but that slow melt up still in play for US indices, especially after that Fed pivot or indication, rather, that perhaps those rate cuts will come early next year. And that is it for this edition of Beat the Street, the show that follows all the trading action, helping you position yourself ahead of the Wall Street Open. For more trading insight, follow me on @Angeline on Twitter. This is IGTV.